morning, and you are very welcome to today's CBI webinar. My name is Kerry Thomas. I'm a partner and editor at a news startup called Tortoise, and a great pleasure as ever to be doing these conversations in conjunction with the CBI. I don't know about you, but I think it's felt to me in the last couple of weeks as if we've arrived at something of a crossroads in the UK. So on the one hand, we've had the announcements from the Chancellor about the extension of the furlough scheme and the extension of the various government-backed loan schemes that we're going to be talking about today. And we had the Bank of England pumping billions more into the economy. And all of those moves seem to point to concern about quite a difficult winter ahead, second lockdown, all those things that we know about. Possibly a worse winter than we were anticipating. On the other hand, then 2 days ago, we had that announcement from Pfizer and BioNTech about the success of their vaccine. And Sir John Bell, who I think is one of the most authoritative medical experts in the country, saying it heralded the prospect at least of a return to what he called normal life by spring next year, which is a prospect I think most of us have barely dared to dream of until 48 hours ago. And I think taken together, what all that means is that it feels as if we're talking about the right things today, because if there are a few more difficult months to get through, then to talk about the government-backed loan schemes and access to finance is important, and that's on the agenda. But at the same time, if there is a glimmer of light at the end of the tunnel, then I think that conversation about growth finance is going to be very important as well. And we're going to make sure that we give time for that today. And thanks to the CBI, we've got a great panel of expert voices to help us navigate that territory, and people who really cover the waterfront here. So we've got people who can cover high street banking finance, non-bank finance, equity finance. We've got a whole range of sources of finance covered on the call today. We've got Lisa Jacobs, who is the UK managing editor of Funding Circle, which many of you will know is, I think, the #1 UK platform for small business loans. We've got Stephen Pegg, who's managing director of UK Finance, which is the umbrella body for banking and finance in the UK. We've got Stephen Welton, who's executive chairman of BGF. Again, many of you will know, a big equity provider. And we've got Ray Newton-Smith, the CBI's chief economist, who, Ray, I'll come to you very shortly. But just to, I think you probably know the drill by now, but really we do want as many questions and comments from you as we can, and they'll really help inform this conversation. But even beyond that, they help inform the CBI about what's happening out there in a way that then can feed through into their conversations with government and banks and all the other big players here. So really useful to hear from you. If you want to contribute anonymously, then please just write anon at the top of your question or comment, and we will treat it, of course, anonymously. So let's get going. Rain, good morning.
Good morning.
Good to have you again. Usually we start with a little review of the sort of big developments of the last few days. I've nodded at a few of them, but what's caught your eye in the last week or two, Rain?
Look, it's, I mean, what another week it's been. I mean, I think, look, I'll start with the vaccine. I mean, it's absolutely great news on the Pfizer BioNTech vaccine, 90% effective. The UK should have 10 million doses available by the end of the year. And it looks like also good news on the Oxford vaccine. I think will soon be hot on its heels. And I think it really has lifted everyone's spirits, right? I mean, I'm not saying we've still got really tough winter months ahead, but I think it's done a lot. It's certainly done a lot for market confidence. And I think it will play a huge role in consumer and business confidence but that's not to underplay. I think that, we're still have some really tough weeks ahead, and we need to have the right economic support to get us all through what will still be a pretty bleak midwinter. And of course, in England, we're now seeing, we're now in our second lockdown. But what I would say is this second lockdown is very different from the first. I think even thinking through the economic impact, back in Q2, our economy shrank by about 20%. I think most people think that the UK as a whole, we might see, yes, the economy will contract slightly because of the restrictions in England and in other parts of the devolved nations, but we're looking at a contraction of around -1, maybe -3%. So it's a totally different ball game to where we were before. But in some sense, we're in that phase where we always knew it would be more challenging. Redundancies at their highest level ever in the last quarter. So rising unemployment is here with us now, and that's why, you know, the extension of the furlough scheme really important. I know we'll touch a bit on that, but really important to have that in place. I think on the wider testing landscape, it's not just the positive news. I think on the vaccine, it's also what's happening around mass testing, including here in the UK. So we have in Liverpool City region, you know, whether you have symptoms or not, you can tests are available. And the PM has announced that he will roll that out to 67 different areas in England, with a kind of weekly allocation of tests for around up to 10% of the population. So it does mean we're into this next phase where we're able to hopefully manage the spread of the virus in a much different way if we can really get that testing up and running. We also saw the good news on students, depending how you feel about it. Good news, maybe, that students can come home for Christmas. So, and I think what they're starting to do, and this is in line with what we'd ask, is giving a bit of a forward plan. So saying that they will allow some provision for testing to universities and a sort of travel window from the December 3rd to December 9th, so that we're not having students all leaving at on one day and a huge sort of travel day around the country, but that it's phased. It's very much linked to testing, so we can really help to control the movement of the virus as students return home for the Christmas holiday. So I think that's really, really sensible. Maybe I'll just sort of cap it off with a bit more around what we've seen on the overall, the announcements on furlough. We had the guidance was published yesterday, and essentially to recap what Annie Gascoigne, our Director of Economic Policy, set out at our webinar on Monday. Essentially what we saw last week is the Chancellor has announced that the furlough scheme in its current form will continue till the end of March. Anyone who was on your payroll up until the 23rd of September, you can put them on furlough. It's the same terms as what we've seen so far, so you don't have to make any contribution for the non-worked hours apart from national insurance and pension auto-enrollment, and there's full flexibility. So I think that will be hugely welcome for the businesses who need to use that scheme, and I think also has a huge knock-on effect, obviously, on household incomes. If you are furloughed, you will the government will help support up to 80% of your income, and I think that will be hugely beneficial. And I think the other thing actually is that if you've been made redundant since the 23rd of September, you can be re-employed under the scheme. So I think that, you know, obviously for some they'll feel that that comes a bit late, but at least it is a lifeline for those who've had to face some tough decisions since then. But I think maybe nice to end up with also some really positive developments on the longer term sustainable finance landscape. We saw the Chancellor on Monday set out his intentions, something we've really been pushing for, working with the Impact Investment Institute, with the Green Finance Institute, that the UK will issue their first green gilt in the coming months. And that is hugely important. I really feel it's somewhere where the UK can lead the world. And also some important developments around businesses disclosing their climate risks. Larger businesses will need to do that by 2025. That's sort of bringing, you know, ordinary businesses in line with what the financial sector has to do already. And then just having a clearer taxonomy on climate risks is something we've really been pushing for. So I think that was hugely welcome news and a really important part of our transition to a net zero economy.
Okay, Ray, just to help us, before I come to Lisa and Stephen, we know that throughout this crisis, access to finance has been one of the great questions that we've talked about on these calls and around them. What has the CBI been asking government for on that front?
Yeah, well, I mean, everything. Obviously, we were really working with the financial industry, with the Bank of England, with the Treasury on setting up the lending schemes in the first place, and they've been such a lifeline for all kinds of businesses, and meant that we've seen 62 billion issued to over 1.4 million businesses over the past few months. But I think this next stage is absolutely critical. You know, so many businesses are facing pressure on their cash flow, and we need a financial system that can do two things. One, help, you know, still help a lot of businesses who are absolutely in survival mode, but then also really help the businesses that are growing through this crisis. There are some businesses that are being created, that are starting up. There are other businesses that are growing, and what we want is more and more businesses to be able to grow and thrive through these tough winter months. So, and I think if we look at the crisis overall, what we've seen so far actually is that consumption, household spending, retail sales have actually recovered so much quicker than anyone expected. So there are opportunities out there, but the bit that is really difficult is business investment. It's still about 20 or 30% below where we were pre-crisis. So it's somewhere where we have our sights really focused on. And I think what we need to see at the moment is, in terms of survival, it's absolutely having the grant funding flowing from the local authorities to those who need. The Chancellor announced 1.1 billion available during this period of lockdown in England to support businesses, along with the £3,000 that each business that is closed will receive. So I think that's still really important. The second bit is around the business interruption loan schemes, allowing businesses to top those up, restructure them as and when they need, will be really, really important. We also need some of the pipes that help finance and credit flow through the economy. So trade credit insurance has been so important, and that comes to an end. The government guarantee of that system comes to an end at the end of this year. We think that needs to continue to the end of June. And there's also important work around, banking dispute resolutions. We've been part of the City UK work. I'm sure we'll touch on that in the discussion. But I think the other bit is really about how we help businesses thrive, how we help them invest. And I think there we're really interested in looking at productivity vouchers for our SME businesses to invest in digital technologies. We're interested in the role of grant funding sitting alongside lending schemes like we've seen in the past through the regional growth funds, which helps to sort of top up the amount that medium-sized businesses can invest and sort of scale up. And of course, there's a huge role for the Business Growth Fund, for the British Business Bank, for our fintech lenders as well, to really help around that sort of growth finance. And I think that's why we've gathered this panel here today, who are real experts and really leading the charge on all of that.
All right, Rain, thank you so much. Well, I'm going to come back to you on a bunch of those things. I think particularly productivity vouchers, which is not something I've come across before, is quite intriguing. But can I kick off with Stephen Pegg? Stephen, Rain touched on a couple of numbers there, just very briefly. But can you give us in a minute or two, what the big picture has been on these government-backed loan schemes and how important you think the extensions could be?
Yes. So thanks very much, Kerry, and great to be here today. Banks and finance providers remain very busy, albeit the flow of applications coming in is not quite as high as it was at the peak period during the late spring, early summer. Nevertheless, it is above normal trend levels. Put it into context, there's been an increase of those using external finance amongst the SME sector from 30% to 40%, and that's changed quite quickly. Over a quarter, you've seen that material increase, and many have not borrowed before at all, so it's kind of new to them. Some sectors, manufacturing, it's 54%. So where there's been particular pressure, they've kind of taken that on. It's very well spread across the country geographically, in line with the economic activity, which is good news. But what you're beginning to see, and I think we'll see increasingly next year, is that very different pattern of business situations, from those still needing support during what is kind of effectively a disruption, and those wanting to kind of get back to growth. And I think we need that diversity of support and schemes, and the commercial finance sector working alongside government support, where in the interruption period there was quite a strong reliance on the bounce back loans, in particular for the small end of the market, to provide that cash injection. And as Rain identified, 62 billion, quite a big increase, but in total outstanding debt for all SMEs across the economy, that's increased total outstandings by about 23%. So it's not kind of, on aggregate, a level of pressure which is unsustainable, but within that, you'll have some real difficult financial pressures for some individual businesses that will need extra support. It's been very welcome to have the Chancellor's pay-as-you-grow options to provide that kind of additional support into next year. But at the same time, you'll have heard the schemes have been extended to the end of January, and also there's the ability of bounce back loan borrowers to be able to top up to the maximum that was available, where they took less than they were entitled to before. Just to remind people, the maximum was £50,000 or 25% of their turnover, whichever was the lower. So, we've already seen in the first day, which was yesterday, tens of thousands of applications come in for that. So, that will be very welcome for many. What we do need now to be thinking about, I think, very much to Rain's point, is the future and how these schemes evolve. So from the end of January, we're going to need further support, but that support needs to help with revolving finance, with trade finance. So we're very conscious, actually, over the year end. We've not talked very much about the end of transition, which is the other big disruption that we're going to see early in the new year. All the finance providers are going to need to be in a position to provide for that as well. There is a new scheme coming on the horizon with UK Export Finance called the General Export Facility, which I think will play an important part. And great opportunities as well, to echo Rain's point about green finance. A lot of enthusiasm about how that can really help the UK's competitiveness. And we've been calling alongside the Grantham Institute for a sovereign green bond, so we were delighted to see that that was announced last time as well. Finally, just wanted to mention, the flows of working capital. Invoice finance plays a really important part of that alongside trade finance. And whatever we do, we must make sure that all of the providers out there, including non-banks, including the specialist providers, can operate and compete alongside the larger players in the marketplace.
Great. Stephen, thanks for that. Lisa, let me just turn to you. Obviously, we are going to come to the future and growth finance and so on, but just can you just give us a picture of what you're seeing through Funding Circle now? Because obviously you operate, you're accredited to the government schemes. You offer those loans. What are you seeing in the demand for finance here and now?
Yeah, I think, and to echo a few things that both Stephen and Rain have said, actually, the amount of funding in the market isn't that much significant. And what we've seen is actually there's been a big increase in the number of businesses who are borrowing online, who are starting to use finance where they've not used finance before. And I think that's quite a change that we've seen. And some of those businesses are in this camp that Rain referred to as the crisis mode. And actually, it's very important for them to get finance through this period. But actually, a large number of them are these amazing entrepreneurs, amazing businesses who have adapted their businesses. They've been very resilient over this period. And the vast majority of businesses that we have kind of in our portfolio have been very resilient, have been making their monthly payments. And we have examples of businesses who've borrowed CBILS because they've had a disruption to their business, but they've used it as growth finance to pivot. So we have a sunglasses retailer who usually has bricks and mortar stores in London, which are obviously getting very little footfall as a lot of people have stayed at home, worked from home, but they've invested in their online presence. They're starting to distribute through their new revamped site. We have a uniform manufacturer who typically is manufacturing uniforms for restaurants, high-end hotels, and has been caught up, as a number of businesses have been, in not just the hospitality sector, but the whole supply chain around that. And they've pivoted to make face masks. They've been very successful in doing that and deployed it through to directly to consumers. So we are still seeing high demand, and it does split into these two camps. And I think, as Stephen mentioned, as we go into the recovery and as these businesses are going to start driving that recovery, it is going to be really important that we cater for those two groups. And that means giving confidence to investors to continue to support businesses where there is uncertainty, whilst also enabling all those businesses who are going to power the recovery to access the finance that they need to do that. And when we have surveyed, there's lots of surveys going on, but when we've surveyed businesses, they've said we need finance. 2/3 of businesses think that they'll need finance going through into next year. And a lot of that is for growth. A lot of that is to see through, but we need to be able to support those businesses and provide that finance to them.
Yeah, and Lisa, it seems to me that an event this disruptive is bound to change the landscape for good. So when you're looking further forward at the industry, how do you think this is going to change things in the longer run?
It's a really good point, actually, and I think you're right. And actually, what has been great to see in this crisis is, if you think about where we were following the last crisis, there weren't really that many small business lenders, and small business lending retrenched significantly. And actually, it's interesting because there has been this well-documented small business lending gap for the last decade as a result of that. And I wonder, actually, if you look at the stats, whether lending has actually fully recovered to there. But what I think is very different now is, if you look at the work, and I think credit to the British Business Bank over the last decade for doing this in the background, supporting more competition in the market. There are now over 100 accredited CBILS lenders in the market. Now, that is great for competition. It is great for small businesses. It is great that there are more places that a small business can go to get finance. It can be a little bit crowded. And what I think has happened during this period is two things. Firstly, as I mentioned, some businesses who haven't borrowed before have borrowed. And secondly, due to just the circumstance, there's been this seismic change across all industries, actually, to be more online. Like, we're doing this event online, people are shopping online, and the same is true in lending. And that has been a change and a shift, which I think is very positive for small business lenders. Typically, technology and customer experience in small business lending has lagged that in consumer. And I think now small businesses will get used to borrowing online. They'll get used to simpler processes. They will get used to having an experience which is very seamless, and they won't want to go back to what they had before. And I think that is positive for small businesses. It's positive for the experience. I mean, we've had 60% of our CBILS loans have gone to new customers. And I do think that we are seeing this shift and this increase across all industries, actually, in online adoption.
Okay, Lisa, thank you so much. Stephen Walton, let me bring you in. Thanks for your patience. Let's turn our minds to growth, because that's really it's high growth businesses that you tend to operate with, isn't it? So when you look around, what do you, when you talk to the people you work with, what do you think we need to accelerate out of this lockdown, accelerate from through the spring and summer of next year?
I think there's sort of three dynamics. Lisa just talked about the agility of entrepreneurs and their ability to pivot, and she's also commented on an acceleration in shifts that were already underway in the economy, and I think those are clearly not going to change, and it's going to leave a very changed landscape, which is going to create different types of issues. But I suppose in terms of funding, we would look at this in three categories. Picking up the role of the banks and the government in supporting the economy through an enormous disruption. I mean, you have to take your hats off to the ability to actually do that quickly in scale. I mean, just looking at the thousands of companies that have been able to access lending from the main high street lenders as well as platforms, that has kept the economy afloat. It has kept unemployment down. And now that we have the potential of an end to the pandemic with the vaccine, I think we have to recognize there is a legacy there. A lot of companies are going to, by default, have borrowed more money than they would have chosen to do. They're going to have to borrow more money through the winter, because clearly this is not going to be over until the spring. And history shows us that coming out of every recession, the peak risk is as you start to grow in terms of access to working capital and to investment. And the challenge this time is that these businesses are much weaker coming out of a recession than would ordinarily have been the case. So part of the challenge here is to look at recapitalizing a range of companies that have struggled through this recession for no problem of their own, and that is going to require the support, obviously, of their lenders, but it's also going to require equity, because there's just not going to be enough strength within their balance sheets. And that's a new dynamic that we haven't seen yet, because it clearly is yet to unravel. As these schemes get extended, the debt is increased, and therefore the problem is not that far down the road, and it's something that we will have to address if those companies are going to be able to really grow as opposed to survive. Then you've got, I think, two other elements. There are those companies that continue to grow because they're early stage and they're high growth, and they just need access to capital. And so that hasn't been affected by the pandemic, and in some sectors it's been accelerated. So areas like life sciences and healthcare and technology are big beneficiaries of where capital is going. The challenge we have there is a different one, which is there isn't enough equity capital. This is much higher risk. It's unproven. It's going to require a long-term and a patient attitude. And there will be not so much a shift, but a broadening of risk investment. And when you start to look at investing in life sciences, for example, the UK has significant strengths there in terms of our healthcare infrastructure and our pharmaceuticals industry, together with all of the knowledge and expertise of our universities. But we are still undercapitalized in terms of the risk equity that we have there. And that's something I would hope is a beneficiary of this crisis, that people will see the need to invest and risk capital will increase. And picking up on Rain's comment, the big area where there is both an opportunity and a necessity is green finance and sustainable finance, which is going to be a combination of equity into companies and project financing. So in that category, we absolutely need to increase the flow of capital to address this question of business investment. And then the final one is the macroeconomic picture. It's very uncertain. And there are a lot of companies that maybe haven't needed to draw down on borrowing facilities and that have essentially run in a much more cautious fashion for the obvious reasons. They don't know what the end of transition means. They don't know quite what the long-term impact of COVID means. And there is a latent need within the economy to give that certainty, to encourage people to invest. So I think of all the statistics we look at, and going back to the one that Rain was commenting on, the significant fall in business investment is the one that we should be most concerned about. That isn't going to hit us next year, but in 5 to 10 years' time, we wonder why we haven't got the high growth champions on a global basis. It's because of the lack of investment that's happening now.
Yeah, and Stephen Welton, you mentioned a couple of times there the problem of access to equity finance. If you wanted to change that, what would you be urging the sector or the government to do to make a difference?
We, along with others, are really focusing on one very specific thing, which is the pension fund industry. And being specific, on the back of auto enrollment, which has been a huge success in encouraging the next generation of savers, we are building a huge savings industry, which is going to be the dominant form of investment over the course of the coming decade. Currently, they are constrained in terms of their ability to invest more broadly. So what we are creating are very large DC pension schemes, which are going to have very conservative investment strategies, driven almost by the lowest cost being the only objective, as opposed to growing absolute returns on assets. And the irony is that we're copying what Australia and Canada has done with their superannuation schemes, and they don't have these restrictions. So we urgently need to address the restrictions around these DC schemes to give the trustees and the people managing these pension funds the ability to actually invest in long-term growth. If we can do that, there is the source of equity capital that will fund all of the innovation and the disruption and the future industries. Without it, I think we will really struggle, because equity risk capital for smaller growing companies is always going to be challenging, and we don't have enough of that anyway, and this pandemic has just heightened that problem.
Kerry, could I just add, building on Stephen's point, I mean, I think the other side of the equation is the demand side, and equity finance, with the notable exception of BGF's very successful kind of regional and devolved nation kind of distribution model, is too concentrated in London and the southeast, and work to enable more support for investment readiness, for connections with investors and so on, all around the UK really needs to go on alongside the development of greater capacity and supply. So connecting those two could be a very powerful means to take advantage of the potential that exists all over the country and in all sectors for growth and development.
Great. Thank you, Stephen. I want to tuck into a couple of questions that have come in. Rain, Stephen Welton mentioned the debt that companies have built up. It was interesting to hear Stephen Pegg talking earlier on about the overall increase, but obviously that will be a lumpy sort of picture. We had a question in worried that businesses may have taken on a huge amount of debt in order to get through COVID. Having taken up their debt capacity, many will struggle to grow without new finance. Have you given any thought, have you had any conversations with the Treasury about converting COVID loans to something else at a future date to help those sorts of companies?
Yeah, I think it's really a sort of three-pronged approach. I mean, I do think there is a role, particularly for businesses at the smaller end, around grant support, so that we're not only relying on lending to get some businesses through. And on that smaller end, it's businesses in live events, in sporting and leisure facilities, in community clubs. There's so many areas that have been impacted by the further restrictions where lending may not be the right tool for them. I think secondly, I think the thing we really pushed for that was really important and really welcome to see the Chancellor did take action on was extending the repayment terms, right? So they got stretched from over 6 years to over a decade. And that means for a lot, if you take your typical bounce back loans, that means the amount of your repayments, goes down by almost a half from next year. And I think that was hugely important and provides a bit more breathing space. Further down the line, I think there really is an important discussion about whether some of this needs to be converted into equity, and we've had a really good discussion here about the role, the important role of equity finance in the growth landscape. And I think traditionally, we haven't had enough equity finance being used, particularly by medium-sized businesses as they grow. So I think thinking to the longer term about how we build more equity finance, but then there's a separate issue around the extent of debt overhang for some businesses and concentrated in particular sectors, whether there's a role for recapitalization of some of that debt. And that's part of ongoing discussions, I think, with the Treasury. We absolutely do see a role for that further down the line. But I think at the same time, we also need to look at access to the growth finance in the interim.
Okay, we've had a few questions in which we're already dealing with access to finance here and now. So I'm going to come to Lisa and Stephen Pegg with a couple of those just quickly, probably. Lisa, one for you, I think. Just you may be able to help us with this. A question from someone who is worried that some small and new companies are being denied access to grants and loans because of fears of fraud. How much does fear of fraud play a part in your calculations at Funding Circle?
Yeah, I think obviously there has been a significant amount of press about fraud, and particularly related, I think, to the bounce back loans, where the level of diligence that a lender would usually do on that business is limited because the speed is the balance between here. From a Funding Circle point of view, then we focused on the CBILS program. We do a little bit of bounce back, but we're mainly focused on the CBILS program. And we do our standard fraud and credit checks that we have done pre-COVID, and that we continue to do. And I think that this is something that lenders do across the CBILS scheme, which is why there's been less focus, I think, on the CBILS scheme in terms of that of the fraud impact. I'll pass over to Stephen as well for kind of the broader industry view.
Yeah. Very important that new businesses can get access to accounts. And there's a good range of alternatives for startup businesses. Just to remind people that bounce back loans, to be eligible, you need to have had a business started before the 1st of March this year. So they will typically, if they do need to borrow, go for other options, including the startup loan scheme, which has seen a big increase in demand. For other businesses that want to access some bounce back loans from someone other than their own bank. You're right, there are delays because of checks required for fraud, but I would say 28 lenders are accredited. They constitute 99% of the business current account providers across the marketplace. So most people are able to kind of get bounce back loans, but there are certainly some delays which have been, unfortunate really for businesses that have kind of been stuck there. What I would say is that there are options available, and you don't have to just use the bounce back loans. There are lots and lots of commercial finance providers who are very keen to provide finance on competitive terms as well, and have money to lend.
Okay, I'll stay with you, Stephen, if I may, because we had a question from Peter Black, who says it's currently impossible to open a new business bank account with any of the major UK banks. That's been the case for some time, but I see they are chasing new personal accounts and offering deals. Do you anticipate that changing?
Yeah, so certainly, most of the larger banks are helping their personal customers with new business facilities, including bounce back loans and so on. They're keen to kind of open for business again as soon as they possibly can. And there has been a real volume issue here, in that many of the people who are the experts on onboarding new customers have had to be moved to support the lending applications, which has clogged things up to a certain extent. And the extra checks because of fraud, requiring that kind of a level of investigation has, constrained capacity to a certain extent. But I would emphasise that, I estimate it's less than 1% who are in this kind of category where they're not able to get help. And there are business current accounts available, including from some of the large players, for new startups and new businesses that require that, but don't immediately need a bounce back loan.
Okay, we'll turn to some other questions in a second, but
Kerry, I think your sound has gone.
Yeah, I've lost Teresa. I was wondering if it was just me.
We can't hear you, I'm afraid, Kerry.
Can you hear us?
We might have to go rogue and ask our own questions. Maybe.
Oh, Rain, I think I'm back.
Oh, you're back.
Oh, you're back. Excellent. Thanks, Kerry. We're about to self-organise, but back over to you, Kerry.
I could see you all laughing. I couldn't figure out what was going on, but thank you for holding the fort. Stephen, did you hear any of my question? I was asking you about confidence and what you were seeing, Stephen Welton, about what you mentioned. Confidence is obviously a critical factor in people making decisions and looking for making calculations about growth and growth finance. What are you seeing and hearing from the people you deal with at the moment about their levels of confidence?
I have to say, it's surprisingly, people, and maybe this is to a point Lisa made earlier, I mean, entrepreneurs are very entrepreneurial. So they can see the world collapsing around them, but they want to sort of overcome whatever those challenges are. What we are beginning to see, which I think is a good thing, is companies starting to recognize there are opportunities that come out of difficulties. So we have regular investment committees, every week. One of the areas that we know there is this fundamental need in the UK is house building, where they know there's an acute shortage of supply. That will not just be dealt by the major house builders, it has to be dealt by regional house builders. People like that wanting to raise more capital, that clearly requires the support of the banks. We all know that there is a demand. So I think we're beginning to see some evidence in some sectors of a willingness to invest. It is very patchy, and I think that will be the overriding view. Those ambitious teams who are doing well are bound to be more, more confident about investing, and businesses that are actually growing through the pandemic. So whether that's in sort of TMT technology, business services, e-commerce, online delivery, businesses which are seeing increasing demand will clearly find it easier to raise capital because they'll want to raise capital. So there is a big cadre of companies that are not seeing that yet. And it's a question of when you take the jump. And for entrepreneurs, I mean, they are agile and resilient, but they also have the equity value that they're trying to build up. So there's this constant balance between risk and reward. And I think, again, I think Rain made this point earlier, the psychological impact of the announcement of that vaccine is huge. Because it's almost, somebody's put up a flag and say this is going to be over now. There is a future, and I think what we will start to see again by sectors are companies thinking, right, maybe we should finally start dusting off our plans. We do have transition as a sort of minor issue over the course of the next 6 weeks, but I would hope that coming into 2021, we should be really gearing up to make sure that capital is available for companies. So whilst they don't know what the future is going to hold, they should be more confident that the funding is going to be there.
Great. Lisa, can I just jump back to you with a question from Simon Middleton? And Stephen Pegg, you might want to follow up if you've got something to say. Simon Middleton asks, he'd be interested in hearing the panel's view on the current challenges that businesses are facing in relation to switching banks. The huge amount of this, he says, is broker-led and isn't happening in the same volumes due to the impact on the ability of banks to open new accounts. Clearly a wider economic impact as a result. Lisa, do you recognise that picture?
Yeah, I mean, I think there's a well-stated stat that you're more likely to get divorced than change your bank account. I think there's always been an inertia in people sticking with the bank that they've got, and I think there's been a huge amount of work that has tried to go into making it much easier. You know, there's been as a result of the Williams and Glyn RBS, there's been, you know, a fund pot to support competition, to support switching in the market. People have even been paying people to switch. So I think, you know, there's a two-sided approach. There's the one which is the demand to switch, and then there's the supply of being able to set up those accounts. I would say, echoing what Stephen said, you know, a lot of focus has been on lending, and I think from lenders' perspectives, from banks' perspectives, they've been trying to support customers through this period, and there's been a huge increase in the volume of loans that they have done, and therefore there have been queues, I think, in terms of the ability to set up new accounts. But what I would say, similar to what Stephen said, is that if it's for lending purposes that businesses are looking elsewhere, there are a number of options which don't require you to wholesale move banks, you know, and therefore, you know, we take new customers. There are a number of other alternative lenders who don't require you to have that banking relationship through your current account in order to access funding. So from that point of view, there's, you know, as I said before, there's over 100 accredited CBILS lenders now, and so there are options for businesses to find finance elsewhere.
Okay. Stephen Pegg, we've just got a minute left. Can I ask you just to turn your eyes to the future? A question really that I asked Stephen Welton earlier on. If we're going to accelerate out of this period, if we're going to come out of lockdown, hopefully through to this vaccine in spring, what's your recipe for accelerating growth through that really important period?
I think, first of all, to encourage and support businesses to get back to business planning and enable them to realize their ambitions. You know, this isn't just about money, it's also about you know, good management, the right level of advice and support. You know, whether that requires you know, better coordination of support through mentoring, you know, a professional community working more closely together with businesses. That demand side is very important, and then on supply side, I think getting back to more of a diverse range of finance, you know, and again, you know, talking to Stephen Welton about, you know, how we make sure that the equity providers and the debt providers are kind of working together to enable businesses to be helped. I think that's kind of my formula. I think that requires, where the government do provide support, for that to work in complement with the commercial market rather than, you know, in substitution for it. And that is going to be the theme, I think, for next year, to enable that diversity and collaboration to take effect. But advice and guidance very much part of the picture too.
Okay, Stephen Pegg, that's a great note on which to end. Thank you for that. Thank you too to Lisa Jacobs, Stephen Welton and Ray Newton-Smith. We are out of time, but it's been a really great conversation. Thank you all for taking part, and we look forward to seeing you again soon.
Thank you.
Thank you.